The history of banking and money creation in the United States is a complex and evolving narrative that began with rudimentary colonial practices and culminated in the sophisticated financial system of today. This essay explores the origins, development, and mechanics of fractional reserve banking, the role of the Federal Reserve, the creation of money through lending, the interplay between government borrowing and taxation, and the broader implications for the U.S. and global economies. This analysis covers the establishment of fractional reserve banking in 1791, the growth of the U.S. money supply, the valuation of national and global assets, and the intricate processes governing currency creation and economic stability, all presented in an unbiased, academic, and factual manner. Origins of fractional reserve banking in the United States. Banking in the United States before 1791 was decentralized and lacked standardization. Most banks functioned as local institutions, serving as secure vaults for valuables such as gold, silver, and property notes. These early banks made limited loans, typically only from the reserves they held, as there was no formal system for lending beyond physical assets. While some colonial banks, such as the Massachusetts Land Bank of 1740, experimented with issuing paper money backed by land or goods, these efforts were short-lived due to mismanagement and lack of public trust. Borrowing was minimal, as many Americans could homestead or claim land in the western frontier, starting farms or businesses without relying on credit. When loans were issued, they were primarily for trade, small business ventures like mills or shops, or land speculation in settled areas, often secured by gold, silver, or land deeds. The establishment of the first Bank of the United States in 1791, located in Philadelphia, marked a pivotal moment in American financial history. Inspired by the Bank of England and championed by Alexander Hamilton, the first bank introduced a formalized fractional reserve banking system. Unlike earlier reserve-based banks, the first bank held only a fraction of its deposits as reserves, lending out the remainder to generate profit. This allowed the bank to issue its own banknotes, which were more reliable than the diverse and often counterfeit-prone notes of local banks, as they were backed by the federal government and convertible into gold or silver. Local banks could exchange their notes or specie for first banknotes, which they held as reserves or used in transactions, though many continued issuing their own notes for local lending. The first bank served as a national bank, managing government funds, stabilizing the economy, and facilitating interbank exchanges, though it also catered to private customers. The first bank's charter expired in 1811 due to political opposition from states' rights advocates and anti-bank sentiment. The Second Bank of the United States, chartered in 1816, continued similar functions until its charter ended in 1836 under President Andrew Jackson's opposition. From 1836 to 1913, the U.S. lacked a central bank, relying on state-chartered banks that issued their own notes, leading to instability and rampant counterfeiting. The Federal Reserve System, established in 1913, became the modern central bank, standardizing currency with Federal Reserve notes and overseeing fractional reserve banking, marking the culmination of a century-long evolution from local, reserve-based banking to a national, fractional reserve system. The mechanics of fractional reserve banking and money creation. Fractional reserve banking is the cornerstone of modern banking, allowing financial institutions to lend more than the reserves they hold, thereby creating new money. When a bank issues a loan, whether for a mortgage, a business venture, or a credit card purchase, it credits the borrower's account with a deposit, effectively generating new money without requiring equivalent physical reserves. Banks are required to hold only a fraction of their deposits as reserves, typically around 10% or less, depending on regulations set by the Federal Reserve. This process multiplies the money supply, as the new deposits can be lent out again, creating further deposits in a cyclical manner. For example, when an individual borrows money to purchase a house, the bank creates a deposit in the borrower's account, which is used to pay the seller. The seller's bank receives this deposit, holds a fraction as reserves, and can lend out the remainder, creating additional money. Similarly, when a consumer uses a credit card to buy a small item like bubblegum, the bank pays the merchant, creating a debt for the consumer and new money in the merchant's account. In both cases, the act of lending increases the money supply, which stood at $21,560 billion in M2, currency, checking accounts, and savings in January 2025. However, this creation of money can slightly devalue the currency, as an increased supply may lead to inflation if it outpaces the economy's productive capacity. The maximum output of goods and services an economy can produce using its resources efficiently. The question of whether limiting borrowing to real assets like land or property would strengthen currency is nuanced. Loans for tangible assets can tie the currency's value to the perceived value of those assets, which may hold or appreciate over time, potentially stabilizing the currency. However, excessive lending for real assets can create asset bubbles, as seen in the 2008 housing crisis, which can destabilize the economy and weaken the currency if not matched by economic growth. Borrowing for consumables, like food purchased with a credit card, creates money without a lasting asset to back it, potentially contributing to inflation, though the impact of small transactions is minimal compared to the total money supply. The growth of the U.S. money supply. The U.S. money supply has grown dramatically since 1791, reflecting the expansion of fractional reserve banking, population growth, and monetary policy changes. In 1791, the money supply was estimated at $10 to $15 million, consisting mostly of gold, silver coins, and early banknotes, as the economy was small and barter was common. By 1913, with the establishment of the Federal Reserve, the money supply had reached approximately $20 billion, driven by the growth of banking and economic activity. In January 2025, the M2 money supply stood at $21,560 billion, encompassing physical currency, checking accounts, savings deposits, and other liquid assets. This growth is not solely the result of lending. The Federal Reserve plays a critical role in money creation through open market operations, such as buying treasury bonds, and quantitative easing, which injects money into the economy. Government borrowing, particularly through the issuance of treasury securities, also contributes to the money supply when financial institutions or the Fed purchase these bonds. The total amount of money borrowed from financial institutions since 1791 is difficult to quantify precisely due to incomplete historical records, but estimates suggest over $150 trillion in nominal terms, including federal debt, approximately $100 trillion, with $36 trillion current in 2025, and private and state/local debt, over $50 trillion, with $20,400 billion in household debt and $21,600 billion in business debt in 2024. The role of the Federal Reserve and the Treasury. The Federal Reserve, established in 1913, functions as the U.S. central bank, managing the money supply, setting monetary policy, and regulating banks to ensure the stability of the U.S. dollar. It determines the amount of currency needed in circulation, instructing the U.S. Treasury's Bureau of Engraving and Printing to produce physical Federal Reserve notes. The Treasury, through the Bureau, prints currency to combat counterfeiting and ensure reliability, while the Secret Service, also under the Treasury, enforces anti-counterfeiting measures. The Treasury's Internal Revenue Service collects taxes, which fund government spending alongside borrowing. The Federal Reserve monitors banks' lending and reserve needs, ensuring they maintain fractional reserve requirements, typically 10% or less, by supplying currency or reserves. It also buys U.S. Treasury bonds, primarily in the secondary market, to influence interest rates, stabilize bond prices, and manage the money supply. When the Fed purchases treasuries, it creates money electronically by crediting banks' reserve accounts, increasing the money supply without borrowing. This process supports market confidence, preventing financial institutions from selling bonds at a discount due to fears of future value loss. The U.S. government borrows primarily by issuing treasury bonds, notes, and bills to cover budget deficits when spending exceeds tax revenue, and to refinance maturing debt. In 2024, the federal deficit was $1,900 billion, with total debt at $45,500 billion. The Treasury sets the amount of bonds issued based on fiscal needs, with interest rates determined by market demand at auctions, influenced by the Fed's target rate, which was between 4.75% and 5% in 2025. Unlike private entities, the government does not borrow directly from banks or use credit cards. It relies on bond issuance, taxation, borrowing, and economic activity. An economy is the system of producing, distributing, and consuming goods and services, with currency facilitating trade by assigning value, eliminating the need for barter. Tax revenue depends on taxable goods and services, so increased economic activity, more exchanges of goods and services, generates more taxable transactions, boosting government revenue. In 2024, federal tax revenue was $4.9 trillion, insufficient to cover spending, necessitating borrowing through Treasury bonds. Government borrowing does not directly create money unless the Federal Reserve purchases the bonds, creating new money by crediting banks' reserves. This process, part of quantitative easing or open market operations, expands the money supply and supports economic stability. However, excessive money creation beyond the economy's productive capacity can lead to inflation, reducing the currency's value. Historical examples, such as Weimar Germany or modern Venezuela, illustrate the risks of hyperinflation when money creation outpaces economic output. Valuation of U.S. and global assets. The net value of all assets in the United States, including real property, personal property, financial assets, and natural resources, minus liabilities, is the national net worth, estimated at $150 to $200 trillion in 2025. Gross assets total approximately $400 to $450 trillion, including $188 trillion in household assets, $48.2 trillion in real estate, $125 trillion in financial assets, $35 trillion in non-financial business assets, $50 trillion in financial sector assets, $15 to $20 trillion in government assets, or $140 trillion, including natural resources, and $125 trillion in natural resources and land. Globally, the net worth of all assets, real estate, financial assets, natural resources, and infrastructure, minus liabilities, is estimated at $500 to $600 trillion in 2025. Gross global assets approach $900 trillion to $1 quadrillion, including $350 trillion in real estate, $345 trillion in financial assets, $200 to $300 trillion in natural resources, and $100 trillion in infrastructure and other assets. Global debt, approximately $400 trillion, reduces the net figure. The global M2 money supply, encompassing all currencies, is $100 to $115 trillion, with physical currency around $10 trillion. Implications and considerations. The fractional reserve banking system, initiated in 1791, has been the backbone of U.S. economic growth, enabling money creation through lending and supporting economic expansion. However, it carries risks, as excessive lending can lead to inflation or asset bubbles, devaluing the currency. The Federal Reserve's role in managing the money supply and stabilizing markets is critical, as is the Treasury's function in printing currency and collecting taxes. The interplay between borrowing, taxation, and economic activity underscores the delicate balance required to maintain currency value and economic stability. The vast difference between the U.S. money supply of $21.56 trillion and the national net worth of $150 to $200 trillion highlights that money supply measures liquid currency, not total wealth. Similarly, the global money supply of $100 to $115 trillion is a fraction of the global net worth of $500 to $600 trillion. These figures reflect the stored wealth in assets like real estate and stocks, which far exceed circulating currency. In conclusion, the evolution of fractional reserve banking since 1791 has transformed the U.S. financial landscape, creating a dynamic system of money creation and economic growth. From the first bank to the Federal Reserve, the mechanisms of lending, borrowing, and currency issuance have shaped the modern economy. Understanding these processes, from the creation of money through loans to the valuation of national and global assets, provides insight into the complexities of modern finance and the challenges of maintaining economic stability in an ever-expanding global economy.